And finally, we will talk with Eric Demerck of Generali Investments about different approaches to managing fixed income. Has the old buy and hold approach to fixed income now been superseded perhaps by a much more flexible philosophy of management?
Yes, we think so. In fact, in the market is right now characterized by high volatility. We have seen some flash crash, even in credit at the beginning of the year. And also, there is no liquidity. We have seen that investors cannot sell fixed income bonds at the moment they want. So in that approach, we favor a flexible approach, which means that absolute return or total return are for us valuable, low volatility and flexible alternative to traditional benchmark funds. And in fact, it is divided in two parts. We have the strategic allocation, which is more or less a biennial approach. We take a medium to long-term view on assets. And we have also a tactical allocation, which means that if we see that there are some risks arising, like the political risk in Europe, we can deleverage or reduce our exposure, mainly by taking some derivative exposure, as the secondary market, for example, on credit, is not liquid. So you can favor to reduce your risk by not selling in distressed markets, but using derivative products. So we think that it offers a valuable tool for investor, and you can have more performance, and for you, volatility is a source of performance, as you can become long or short depending on the market conditions.
From what you're saying, Eric, I get the feeling you favor the absolute or total return approach to fixed income rather than tracking the benchmarks.
Yes, clearly, generally, we think that they offer a flexible, valuable, low volatility approach that is more useful for investors than traditional benchmark, where you take you follow your benchmark, but there are no high conviction trades. So on that, we have modified our array of funds in the last months. For example, we had a traditional high yield benchmark, and we have modified it into a total return approach, where we can use derivative products, and we can have performance whatever are the market conditions. So it's an improvement, and we have also done that process on absolute return convert. And why I think that we will see more and more improvement like that is that in such a strategy, you can, depending on the market condition, favor one kind of trades. If the market is negative on a traditional benchmark fund, you can only you cannot take positions that are not into your benchmark, or only small position. In an absolute return fund, you can use derivatives, so you can go short the market, and you can make performance even in bearish market. And in a bullish market, you can do traditional biennial, but also use derivatives if derivatives are less expensive than traditional cash bonds, for example.
Well, there are interesting times ahead, clearly, in the bond markets. I hope it's not too much of a roller coaster for you, and I look forward to our next conversation. Thank you very much, Eric Demerck.
Thank you, Jörg.